In this video, we are going to look at simple ways to let your profits run in Forex, indices, and crypto, or any other markets you may be trading. I am sure you have heard that it is important to let your profits run and cut your losses early. We will look at different ways to do this and go over the benefits and drawbacks of each method. The most important thing is to trade consistently. When running profits, we look to catch big market movements in relation to our risk. If you pick and choose when to do it, maybe abandoning your plan after a loss, you will not receive the benefits. You can also use some of the methods we will go over together to create something that suits you and how you trade. We will look at 5 ways to run profits. 1. Using a predetermined risk-reward target. 2. Using a moving average. 3. Using significant candles. 4. Stop to break even. And 5. Using partial profits. We will look at each of these methods using slides, and then we will go onto the charts and look for some examples. Okay, let's get started with using a predetermined risk-reward target. This one is relatively simple. You aim for a fixed risk reward on every trade. Let's say 1 to 3 risk reward. We will use this bullish pin bar as our example for all of the methods. Here we are risking 10 pips. Using this method, we would only exit the trade once we had 30 pips of profit, which is 3 times our risk. When the trade reaches 30 pips, we take profit. We are letting our profits run for 30 pips and cutting our losses early for 10 pips. What are the benefits of this method? It is simple. Once in the trade, you set target and that is it. You know you only need to be correct on 25% of your trades to break even. It doesn't require screen time. You set your profit target and stop, and that is it. What about drawbacks? Often, the market will reach a good profit level, say 1 to 2 risk reward, and then come all the way back and take you out for a full loss. If you see this happening repeatedly, it can be emotionally difficult to deal with and encourage mistakes or emotional trading. Now let's look at using moving averages. With this method, we allow a moving average to tell us when to exit the trade. We wait for the market to close below the moving average, or we have our stop set just below the moving average. Here we can see a moving average. The faster the moving average, the less room it will give the market to make pullbacks before signaling an exit. A slower moving average will allow more market movement, meaning potential larger profits, but it will also allow much bigger pullbacks before signaling an exit, meaning you give back a lot of profits. We will say the blue line is a faster moving average and the orange one slower. As we move up, our stop can be just under the level of the moving average, or we can wait for a candle to close through the moving average. With the first option, we close as the candle breaks below the moving average. With the second option, we wait for the candle to close below the moving average. A third option would be to wait for a candle to break the low of the candle that closed through the moving average. It comes down to how much room you want to give the market before exiting. The tighter you are, the less profit you will give back on moves. However, you are also less likely to catch the very big market moves. For example, the next candle may have done this. Your slower moving average would catch this. Or, if your exit had been after the market breaks the low of the first candle to close through the faster moving average, you would also have remained in the trade. However, if the next candle had done this, and you were using the slower moving average, you would be exiting at almost break even after being in good profits. We will look at examples on the charts. The main thing is to be consistent in what you do. If you try and guess what the market will do and use a different approach and moving average each time, you are setting yourself up for failure. What are the benefits of using moving averages? They can allow the market to make normal pullbacks without taking you out of trades. They can help you catch big market moves, but also protect you when the market is starting to reverse or the trend weaken. Some drawbacks would be, it requires screen time, since you are watching the moving averages for signs. You can give back large amounts of profits depending on the moving average being used. It can pull you out early when the market is still trending, depending on the moving average you use. Now let's look at using significant candles. With this method, we move our stop up as the market produces significant candles in favor of our trade. Significant is a bit ambiguous, but you can usually spot them fairly easily. A good tip is to look for a candle that has a body that is larger than at least the previous 5 candle bodies. Here we see a significant candle, so our stop comes to just below the low of the candle. We wait for the next significant candle, and then the stop comes up to just below the low. Eventually, you get stopped out. What are the benefits of this method? This also allows the market to make pullbacks without taking you out of the trade. It is using market strength to determine your stop. Some drawbacks would be, there may not be many significant candles. That means your stop will remain a good distance from current market price. Again, you may give back large amounts of the position before being stopped. It also takes screen time, since you need to check each candle. Number 4 and 5 are both things that can be used with the other 3 quite easily. You may decide to use them to further improve how you run your profits. Number 4, stop to break even. This allows you to protect your position as you look to run profits. I will show you another way to use this when we look at partial profits. You can bring your stop to break even once the trade reaches a certain level of profit. This means you can still let the trade run, but can no longer suffer a full position loss. When I use this, I usually get my stop to break even once my trade has reached around 1-to-1 risk reward. So in this example, the trade reaches 1-to-1 at 10 pips of profit. The stop then moves to our entry level. Now if the market reverses, I am stopped at break even and do not lose any money. Some benefits of doing this would be, you can still aim for good risk reward, but have protected your trade. This can help with emotional trading. Even if the market reaches 1-to-2 risk reward instead of 1-to-3 and then reverses, you will not lose on the setup. It allows you to get away from the computer. The main drawback is that you will suffer quite a few break-even trades that would have still hit your profit target if you hadn't moved your stop. What about using partial profits? We will look at 2 ways to use partial profits to run your profits. First, we can use partial profits to protect our trade and then let it run, similar to bringing our stop to break even. Let's say our trade reaches 1-to-1, 10 pips in this example. However, instead of bringing our stop to break even, we now close out 50% of the trade. So if we were buying the equivalent of £10 per point, we would close out £5 per point. We would now have locked in £50 profit, or 50% of the trade. If you do not move your stop level now, it is effectively at break even. If the market hits your stop, you will lose £50. However, you have already locked in £50 profit. This would leave you at break even. Why is this useful? Now the market can make a lot more movement before you are taken out at break even. It is a very useful way to run profits. In this example, simply bringing the stop to break even would result in a break even trade. However, using partial profits, you can remain in the trade and still be protected. The benefits would be that you can still protect your trade at break even. You are allowing the market more room to move before you are taken out at break even. A drawback would be that you are effectively reducing your potential profit by closing part of your position early. The other way to use partial profits is to lock in profits at different levels. So you may decide to lock in 50% at 1-to-2 risk reward and then only run the remaining 50% for 1-to-3 risk reward. Here, we say we close 50% at 20 pips, which is 1-to-2 risk reward. If we are betting £10 per point, that's locking in £100 of profit. We would then close the remaining 50% at 30 pips, which is 1 to 3 risk reward. That would equal a further £150. Total profit would be £250. The benefits of this would be that you can lock in profits along the way. So if the market does then reverse back to your stop, you still have profit. It also allows you to still aim for large risk reward levels, but remove profits along the way in case the market doesn't reach those levels. The main drawback is that you are reducing your position size, so potential profit is reduced. In our previous example, at 1 to 3 risk reward, you returned £250. However, if you had used your full position, rather than taking partial profits, you would have made £300. Now let's move on to the charts. I will find some examples and also explain a few more ways to use the methods. Okay, now what we're going to do is we're going to start looking at these 5 methods on the charts. So a couple of different things with this. The first one is with these methods, you can kind of pick and choose and you can integrate 2 together to develop something that suits the way that you trade. It's all about being comfortable with what you're using when you're trading so that you can execute your trading plan effectively. Now, the second thing is, as I've gone over a couple of times in these videos, consistency. If you are looking to trade and you're trading in a way where you're looking for very good risk to reward on your winning trades, then you are, by the very nature of what you're doing, going to suffer more losses and more break-even trades. It's just unavoidable. If you're looking for, let's say, 1 to 3 risk to reward from trades, or if you're looking for throughout the month to catch a couple of the very big movements, on your other trades, it's very likely you're going to have very small profits, break even, or you're going to watch the market going into profit, reversing back and taking you out. Now, what I find is that when I'm teaching people, a very high portion of them, they'll ask about risk reward trading, and I'll teach them something that they can do, or I'll show them a method they can use. And what will happen is they'll use it maybe 2 or 3 times, and they'll have a couple of break-even trades and a loss, and then they'll abandon it and they'll move on to something else. With trading, it really comes down to what happens throughout the month, the 2 months, the 3 months, rather than trade to trade. So what we're going to look at is these 5 methods. We're going to start with the first one, which is using a predetermined risk reward level. Now, I've loaded up the DAX and we're on the 1 hour time frame. We've also got Euro USD. We'll do this one on let's do the 15-minute time frame. Let me just change this so we can see it a little bit better. Okay, perfect. We'll start on the DAX. With a predetermined risk reward level, yeah, it's very, very good. With this one, you should have already done your testing of your trading plan. You should know the risk reward level that you need to hit on your winning trades to leave you profitable overall, because all you're doing is you're waiting for your setup. Let's say a pin bar here, or let's say a pin bar right here, and then you're simply holding the trade. So let's say we enter above the high of this one, and the stop is down here somewhere. We enter above the high here, and the stop is down here somewhere. So with this one, we're risking 52 points. So we'll say 50 points to make it easy. So we're looking for 1 to 3. We're looking for 150 pips, which is up here somewhere. Now we're in this trade, no matter what happens, until it reaches that level or comes back and stops us out. The exact same thing would happen with this one. We'd be risking around about 55 points. So 165 would be looking for us around about up here somewhere. Now, when you get trades like this, it's fantastic because you hit your profit target. But as you start looking for higher risk reward, what you tend to find is your strike rate starts to come down. And what you're going to have is you're going to have more losses. A lot of people, when they're using these methods, they start to suffer from things like emotional trading. You know, they'll have a run of losses, 3, 4, 5, 6 losses in a row, and then their next trades are going to be the ones that are going to hit the 1 to 3 risk to reward levels, but they start to abandon their trading plan because things seem to be going wrong. So with this one, you just simply have to get into your trades, you set your entry, you set your stop level, and you're looking for that risk reward. So 60 pips, so around 180. It's all the way down here somewhere. It's a great way to trade. I'm not knocking it, but what I find is that for most people, it doesn't really work with them psychologically. You know, they can't really handle the drawdown. So what can we also do? We can use moving averages. So what I'm going to do is I am going to add a couple of relatively common ones. So the moving average, we're going to use the simple, we'll use the 6-period simple moving average, and we'll make this one blue. So this would be considered a relatively fast moving average. We're also going to add a slightly slower one. So moving average, again, we'll use a relatively common one, the 20 simple period. We'll make this one an orange-red color. Okay, so with this one, you're getting into the trade, and then you're using the moving average as your indication of when to come out of the trade. So we've already gone over this in the previous section of the video. So let's say this is our entry again. We get into the trade, it presses up. We're looking for the market to either come down and test at the exponential, which is here, the simple moving average, and that's our exit sign, or we're waiting for the market to close through the moving average, which would be here, and we exit on the close through, or as the market breaks the low of the moving average right here. And what you can see is as we catch trending movements, let's come to a trending movement. As we catch trending movements, very often, it's going to follow one of these moving averages. The 20 moving average is giving the market more room to make these movements. So we press all the way up, we start to get those pullbacks, we hold just up above the 20 moving average, we get another strong move up, and then we make that move down. So this one, as you're trading, what you're going to find is you're going to have lots of small trades, and then you're going to hit a trade which is going to produce this much larger profit. I used to trade exclusively using a moving average. Basically, I'd wait until the market got to a certain profit level, and then when I got to that profit level, I was just using the moving average. And what used to happen is, for maybe 7 or 8 out of 10 trades, the market would then press a little bit higher, break back through the moving average, and what would happen is I would give back a lot of the profit. But for maybe 2 or 3 times out of those 10 trades, the market would keep going, and I would have a very, very good risk to reward trade. And overall, that left me profitable. Moving averages, they're great things to use, but what you have to realize is the main drawback is going to be lots of trades where it just moves a little bit and then you start to get the close through the moving average. So right here we can see you got your pin bar, we start to break up and we start holding up above our 6 moving average, we press all the way up, it then closes through here. This would potentially be your exit, or zoom in a little bit, this would potentially be your exit, or you bring your stop up to below the low. With this one, as we start to press up, we gain the 20 moving average. So if you're using the 20, this one, the market doesn't close through and you get held in for a stronger move up. But then what you can see is as we start to press up like this, you have a much longer drawdown or pullback before it reaches that 20 moving average. And this one is looking to catch the sort of much longer term trending movements that markets can have. So let's look at it on Euro USD. I'll just quickly add the moving averages. We'll add the 20 again. And we'll also add the 6, which is blue. It's very, very simple. The arrows on the screen, that's just software that I use to identify potential setup candles. You don't need to pay attention to it. Okay, so what we can see is the market, when we're making these large trending movements, very often they're going to follow a moving average. So you can see the 6 moving average, you get the very strong move up, then you get the pullback. And as you get the break through the moving average, this could be your exit, or your stop comes up to just below the candle that breaks through the moving average. You could also exit as soon as it comes down and touches the moving average. With the 20, it's giving it slightly more room. And in this occasion, it's making a nice move up. Now, with that, it's not always best to have the slower moving average. It has a couple of these sort of examples we've looked at. It looks very good, but quite often what you will see is the market breaking through the faster moving average and then making a much larger pullback before it reaches the 20. And all that would happen is, instead of, let's say, closing out at 1-to-1 risk to reward, you'd end up closing out at the break-even level. So there's benefits and there's drawbacks to this as well. With everything we're going to go over, it's going to be the exact same thing. There's no perfect method you can use when you're trading. You're looking for what is going to work for you over the long term. So what's going to work for you? Well, first of all, with your trading plan, it has to work with your trading plan. If you are not taking entries like this, let's say at this point here, throughout the trading month, then it's not going to work for you. So first of all, your trading plan has to be a good trading plan. It has to find you those good entries. And then you need to start looking at overall, using these methods, is it going to leave you profitable? And then you're going to start looking at which one suits the way you trade. Because you might find that using a moving average, giving back profits on lots of trades just doesn't suit you. And if that's the case, then you can move on to something else. Let's say using significant candles. Again, this is another really good way to let your profits run. So again, we're going to be using the potential pin bar right here. The market presses up very strongly right here. Now, what you could say is the first candle. Yeah, the first significant candle, you just move your stop up to just below the low of this candle. What you could also do is you could start using maybe the stop to break even or the using partial profits. So getting your stop to break even, as it presses up, if you get to 1-to-1 risk to reward, you may decide to move your stop up to the break even level. So with this one, we're risking 50 pips. So that would be around about here somewhere. Your stop would come up to the break even level, and then it would eventually come back down and take you out at break even. So a significant candle, you can see the body is much larger than the previous 5 candle bodies. The market sort of moves sideways a little bit. You get a relatively strong candle here, which is the body is larger than the previous 5 candle bodies. So again, your stop would come up to just below the low of the candle. The market then moves. You get another strong candle here, and your stop comes up to just below the low. And then what happens? The market moves sideways, comes back down, and takes you out at this level. With this pin bar, we'd be doing exactly the same thing. So you get a very strong candle to start you off. Maybe you're not looking at the first candle right after you get triggered in, but your stop comes to below the low. So you've just moved it up ever so slightly from your original stop level. Then you get a strong candle here. Now this candle, the body is not larger than the previous 5 candle bodies. However, it's still a fairly significant candle. If I seen this, I would definitely consider getting my stop up. So let's say we move our stop up to here now. The market starts to move again. This one here, very significant candle. Market starts to chop sideways. Get a little bit of a pullback, then you get this candle. So this candle body is larger than 1, 2, 3, 4, 5. So your stop would come up again. Then you get a little bit of a move up, another very strong candle body. So you move your stop up. You get this one. Then you start to move sideways a little bit, and then you get the pullback. Now you don't take out this stop level before you get another very strong move up. This would be your candle. So this one here, you've got 1, 2, 3, 4 candle bodies, but this one is much larger. So you'd wait until you got this one, and your stop would come up. And that's all you're doing. And this one, it's giving the market plenty of room to make pullbacks because you're only moving up as you're seeing the sort of flood of buyers or the flood of sellers coming into the market. So let's try and find an example of a sell position. Now, we can actually start here. Let's say we take this as our first entry. So what I don't want to do is just look at the positives of the different types of running your profits, because in reality, when you're trading, there's going to be losses. So this one, the market starts to move down. You get a strong candle body right here. So it's bigger than 1, 2, 3, 4. It's not bigger than this one. So you hold. You then get the move back up. You get this candle body right here. So now your stop moves down. The market starts to move down. You get the market chopping sideways a little bit. Nothing really significant. This one here looks like it's bigger than 1, 2, 3, 4, 5. Just double check. This one's around about 3 pips. This one's around about 3 pips. Let's say it's even the same. So you wait for this one. Your stop comes down ever so slightly, just below, just above the high. This would be at your break-even level now, and you get taken out at break-even. Now, what you can do is when you're getting sideways price action like this, if you are not seeing any strong bearish movements, just bring your stop to break-even. Yeah, so that's us starting to use the stop to break even on top of the significant candles. Now we start to move up again, we've got a pin bar here. Let's say this is your entry. The reason I'm using this one rather than this one is because the market doesn't break down below the low of this one. It's one of the things I look for if I'm selling, the market breaking the low of the signal, if I'm buying, breaking the high of the signal. So straight into a very strong candle. We then get a little bit of a move down, we get another significant candle. Stop goes to just up above the high. Market comes down, you get this one. This one here, it looks like potentially it's bigger than this candle body. So let's say you bring your stop down right here. And you get taken out on this spike up. Okay, so very, very simple. Everything we're doing in trading is simple. The difficult part is executing it repeatedly without making mistakes and without allowing your emotions to get involved. Now, we've already looked at really stop to break even. Stop to break even, if you're in a trade, let's say when it gets to one-to-one risk to reward, you bring your stop to break even. You're protecting your trade. What that also means is if you wanted to, once it's protected, you can just get away from the screen. Now, stop to break even is very useful if you're using something like a predetermined risk reward level, because it's once you get to one-to-one, rather than then having the trade come back against you and take you out for a full loss, you can protect that position. Very often what you're going to find is as you do your back testing, your trades are going to get to a certain level and then they're either going to hit your profit target or they're going to fully stop you out. There's going to be a kind of like a certain level where it's very unlikely if it then comes back to your entry level, it's still going to hit your risk reward level. So once you find that through testing and through trading, you can then start bringing your stop to break even. Now with partial profits, we can actually use a couple of different things here. It's actually a really, really useful tool when you're trading. So let's say this one right here. We're risking around about 50 pips, I believe it was. So when we get to 50 pips, we're at one-to-one risk to reward. Now, if we close out 50% of our position on this one, if the market comes down and hits this stop level, it's now taking us out at break even. What does that mean? It means you can then lock in the profits and then you can let the trade run. You can give it a lot more room. So if we had just brought our stop to break even at this level, once it got to one-to-one, what's going to happen? It's going to come back down. It's going to take us out at break even. If we use partial profits and close out 50% at one-to-one, we're still at break even, still protected in the trade, but the market has to make a much stronger pullback to take you out. And what you can do is you can just then let it run for very significant market movements. And what will happen is you'll get taken out of break even quite a few times, but you'll catch very big moves also throughout the month. And that's what you're looking to do. Now, another way to do it is, let's say this one, we're risking around about 55 pips. As the market starts to hit profit levels, you can start to take money out of the market. So once we get to around about 1-to-2 risk to reward, you may decide to close out 50% of your position. Now you've locked in profits at this level. On top of that, you might decide to bring your stop to break even. So now your trade's protected, you've locked in profits. And then you might decide, okay, what I can see with this market is it's making a relatively strong trending movement. So now that I've locked in profits at the 1-to-2 risk to reward, so I was using a predetermined risk reward target, now I want to run the remainder of the profits using significant candles. So your stop's at break even, you look for significant candles, you bring it up to the low, you wait for another one, you bring it up to the low, another one, you bring it up to the low. In all honesty, if I seen this trading, I'd very likely bring it up to the low of this candle also, and eventually get taken out. Very unlikely I would wait for this one all the way over here and then bring it up and then catch this whole move. It's very easy to say it's a huge movement, this is what I would have done, but that's likely the approach I would have taken. So for this pin bar right here, we get to 1-to-1 risk to reward. We close out 50%, so we're now protected on the trade at break even, but we don't move our stop. And then we decide to use a moving average. We're using the 6 moving average. So we let the market, it spikes up like this, but then it collapses back down again, so we're not coming out of the trade. We get this one here. Now I'd say this is a very minor close through the moving average, but potentially, as it closes through the moving average, you bring your stop to just above the high and you get taken out, or you wait for a more significant break here, and you get taken out as the market starts to spike up. So we're kind of using different methods now to build something that suits the way we want to trade. That's pretty much everything. Let's look at another thing with the partial profits. So another thing with the partial profits, instead of not moving our stop, we're going to move our stop to break even. So once we get to 1 to 2 risks to reward, so this is, we're about 221, so we're about 42. So down here, we lock in 50% profits, but then we bring our physical stop down to our entry. So now what's going to happen is if it does come back up and hit us here, we're still going to get taken out for profit. And then what we're going to do is, as the market starts to come up like this, we get a fairly significant pullback. You're going to say, okay, now what I'm going to start doing is I'm going to run the remainder of this profit using significant candles. So 1, 2, 3, 4, 5. This one is not bigger than the previous 5 candles, so we're waiting for that significant candle, which we get here. Stop comes to above the high. Market starts to come down, you get another strong candle, stop comes to above the high, market starts to make its move down, you get a nice little pullback here, strong candle, stop comes to above the high, market comes down, and then it pulls back and takes you out. Okay, so that's pretty much everything for this video. Those are 5 different ways that you can run your profits. Very important when you're trading that you cut your losses early and you let your profits run. Now, most important, as I have gone over repeatedly, it needs to fit with you and the way you trade, and it needs to fit with your trading plan. So what you really want to do is you want to test different methods, find one that suits you, but mainly find one that's going to leave you profitable. And then you can start to implement it into your trading. You'll start to find very quickly if it's something you're going to be able to use psychologically. And then as that happens, all you're doing as a trader, you're executing the same thing over and over and over again. Just basically hitting repeat. Every time you see your entry signal, you just hit repeat, do the exact same things over and over again. Okay guys, so as always, I hope that was helpful. I'm James Orr, and thank you.